Setting aside a certain amount of money each month from our paycheck is usually the first thing that comes to mind when we think about saving money. But is saving on its own sufficient to achieve long-term financial security? We'll explain why most business owners and entrepreneurs believe that saving money will keep you impoverished in this video. You may be surprised by the solution, so keep watching. Why saving can keep you poor? Saving money is a terrific approach to start accumulating wealth, but you should also diversify your assets and begin investing. The sooner you begin investing, the longer your investments have to grow. Investments allow your money to expand far faster than it would with just saves. So if you simply save money, you are building your fixed wealth. However, once you begin investing, your wealth grows tremendously. Investing, a smarter way to save. If you're watching this video, you're probably looking to protect your future and retire comfortably. Investing involves taking on risk in order to get a larger return than a savings account. However, there are other low-risk investment options that can be ideal for first-time investors. If you're trying to save money, you should ensure that you have enough money to cover all of your bills. On the other hand, if you're looking to invest, you should make sure you have enough money to buy your first home or last through retirement. Difference between saving and investing. Saving money is a method of putting money aside for specific purposes, such as purchasing a car, paying for college, or emergencies. It is typically saved in a savings account or emergency fund with a lower rate of return than inflation. Investments, such as stocks and bonds, aim to make a profit and increase assets. While saving is crucial for financial security, it is not enough to achieve long-term financial stability. How much should you investing? What amount should you invest? If you decide to begin investing your money, the next decision is how much to invest. The simplest approach to calculate how much you should invest is to follow the rule of thumb. Previously, it was recommended that you invest 10% of your income, but in recent years, this has been increased to 20%. If you can afford it, invest more. Choose your investments wisely. When investing, it's crucial to choose wisely, considering various investment vehicles like stocks, bonds, or property. Different investment strategies, such as real estate, businesses, or high-yield programs, depend on personal goals and risk tolerance. While it's challenging to predict the market, investing in companies with growth prospects can yield long-term profits. For example, if you want to invest in Google, it's essential to review its financials and determine if it's worth the investment based on your risk tolerance and goals. Reason most don't invest. Most people don't invest due to misconceptions about investing, such as not knowing what an investment is, starting a business, and fear of losing money. These misconceptions can reduce financial security in the long term. The biggest misconception is that investing is risky, but minimizing risk can be achieved by choosing index funds and investing in established companies. Starting early is also possible, and it's never too early to start investing. I hope you learned something new today and understand why you should start investing to build your wealth. Do you invest your money? What do you believe is the safest approach to invest? Share your plans in the comments area below. If you like this video, give it a huge thumbs up and share it with your friends. Thanks for watching.